There are moments when a system does not collapse, but subtly detaches from its own assumptions. The structures remain in place, the language continues uninterrupted, and the mechanisms appear to function as designed. Yet beneath that surface, alignment quietly disappears. This kind of dislocation is difficult to recognize because it does not announce itself. There is no single event that demands attention, no obvious rupture that forces collective acknowledgement. Instead, the signals emerge as absences, distortions, and hesitations where confidence once moved freely. Most participants do not notice this shift because the system still produces familiar outputs. Markets still trade, institutions still communicate, and policy frameworks still operate. The difference lies not in visibility, but in coherence. When dislocation begins, cause and effect loosen their relationship. Actions no longer produce proportional outcomes. Interventions generate diminishing responses. Stability becomes performative rather than structural. This is the condition that often precedes larger adjustments. Not panic, not collapse, but quiet misalignment. A phase where the system is still standing, yet no longer balanced on its original foundations. What makes this stage dangerous is not volatility, but normalcy. The absence of obvious stress reassures observers that nothing has changed. Meanwhile, the underlying pressure continues to accumulate, unpriced and largely unspoken. It is in this space that the most important signals appear. Not in headlines or breaking alerts, but in behavior. In what institutions stop doing, not what they announce. In how capital hesitates, reallocates, or withdraws without explanation. The global financial system is currently exhibiting this kind of behavior. Not loudly, not dramatically, but consistently. Something fundamental has shifted, and most participants are responding instinctively rather than consciously. That response is the signal. It is tempting to frame every period of stress as another cycle, another replay of familiar dynamics. That impulse itself is a sign of fatigue. Systems under prolonged strain often rely on historical analogy as a form of reassurance. What distinguishes the current moment is not the presence of risk, but the exhaustion of mitigation. The tools that once absorbed shocks have been repeatedly deployed, refined, and extended. Their effectiveness now depends more on belief than capacity. Institutions behave differently when they sense this limitation. They become more cautious in public language, more selective in intervention, and more focused on managing perception rather than resolution. This shift is subtle but persistent. Structural exhaustion expresses itself through hesitation. Policies are delayed, adjusted incrementally, or framed as temporary even when permanence is implied. Confidence is maintained through narrative continuity rather than demonstrated resilience. Another distinguishing feature is the behavior of capital itself. Capital is adaptive, not ideological. When it begins to prioritize optionality over yield, or mobility over return, it reflects a reassessment of system reliability. This is not the same as fear. It is closer to doubt. Doubt about whether existing frameworks can absorb future stress without introducing new distortions. Doubt about whether intervention still stabilizes or merely postpones. Unlike earlier periods, this doubt is shared across institutions rather than concentrated at the periphery. It manifests in coordinated caution rather than isolated alarm. That coordination creates the illusion of control while masking fragility. The system is not facing a single shock. It is facing the cumulative weight of unresolved adjustments. Each deferral compounds the next until the structure begins to rely on continuity itself as a stabilizing force. That reliance is the difference. When stability depends on belief rather than balance, the system becomes sensitive to signals that would otherwise be absorbed. Small disturbances carry disproportionate informational weight. This is the environment in which quiet dislocation becomes meaningful. Not because collapse is imminent, but because resilience is thinning. History does not repeat precisely, but it often rhymes in structure. Certain periods reveal similar patterns of behavior when systems approach internal limits. These patterns are less about events and more about responses. One such period emerged during the late stages of the Bretton Woods framework. Capital began to move in ways that contradicted official assurances. Confidence in fixed arrangements weakened not through public rejection, but through quiet circumvention. Institutions maintained formal commitments while informally preparing for change. Gold movements, reserve adjustments, and policy language revealed a system preparing for redefinition without admitting it. The break occurred only after confidence had already eroded. Another precedent can be found in the years preceding the global credit dislocation of the late 2000s. Risk was not mispriced because participants were unaware, but because the system depended on its continued mispricing. Signals appeared in funding markets, interbank behavior, and balance sheet opacity. These were not headline events at the time. They were technical irregularities that indicated growing mistrust beneath surface stability. Policy responses during that period were characterized by delay and minimization. Language emphasized containment and strength. Even as interventions grew larger and more frequent, confidence was managed until it could no longer be simulated. A third reference lies in sovereign debt stress episodes where confidence deteriorated before yields reacted. In those cases, capital repositioned silently, liquidity thinned, and policy credibility became conditional. Across these examples, the common thread is not crisis, but transition. The system did not fail suddenly. It drifted out of alignment until a reconfiguration became unavoidable. What matters is not the timing of the break, but the presence of preparatory behavior. Institutions act defensively before they speak defensively. Capital reallocates before narratives adjust. These precedents suggest that the most informative period is not the moment of collapse, but the phase of quiet inconsistency that precedes it. That phase is where the current system appears to be operating. The dominant signal in the current environment is not inflation or deflation, but liquidity strain expressed through trust. Liquidity is often misunderstood as abundance of money rather than confidence in exchange. When trust is intact, liquidity flows efficiently even under stress. When trust begins to thin, liquidity fragments. It becomes selective, conditional, and increasingly dependent on institutional guarantees. This fragmentation does not immediately reduce overall liquidity measures. Instead, it alters distribution. Some sectors experience abundance, while others face scarcity, even within the same system. The signal appears in the form of cautious lending, preference for collateral, and rising importance of central intermediaries. These are not failures, but adaptations to perceived uncertainty. Monetary policy operates most effectively when it amplifies existing confidence. When confidence weakens, policy becomes compensatory rather than catalytic. Each intervention must work harder to achieve the same effect. The system responds by layering mechanisms. Facilities are extended, frameworks adjusted, and communication refined. These actions stabilize outcomes but do not restore underlying trust. Capital recognizes this distinction. It responds not by exiting entirely, but by shortening duration, increasing optionality, and reducing exposure to structural commitments. This behavior is often misread as tactical or cyclical. In reality, it reflects a reassessment of system reliability over time. Liquidity becomes cautious because trust has become conditional. The misunderstanding arises because liquidity strain does not look like scarcity until it is advanced. Early stages resemble efficiency improvements or risk management. Only later does the system realize that flow has become constrained. This is why the signal remains largely unnoticed. Metrics still function, markets still clear, and policy still operates. Yet beneath these mechanics, trust is being rationed. That rationing is the signal, not visible in aggregates, but evident in behavior. When a primary signal is present, it rarely appears alone. It is reinforced by secondary indicators that validate its persistence. In the current environment, these confirmations are emerging across asset classes. Bond markets, for example, reflect a tension between safety and skepticism. Demand exists, but it is conditional. Duration is approached cautiously, and pricing embeds uncertainty rather than conviction. Currency behavior provides another layer. Movements are less about relative strength and more about relative resilience. Capital seeks flexibility, favoring instruments that preserve optionality over those that promise stability. Credit markets offer further confirmation. Access remains open, but terms tighten quietly. Covenants matter again. Risk differentiation increases, signaling a reassessment of default assumptions. Metals and other non-yielding assets exhibit delayed response. They do not move immediately because their role is not transactional. They function as balance sheet anchors rather than speculative vehicles. Together, these signals form a coherent picture. They do not point to imminent failure, but to systemic caution. Capital is not fleeing, but it is repositioning. This repositioning is consistent with liquidity strain driven by trust. When confidence is abundant, capital extends. When it is conditional, capital consolidates. The confirmation lies not in extremes, but in consistency. Across markets, behavior aligns around preservation rather than expansion. That alignment is the message. Hard assets, particularly silver, occupy a unique position within financial systems. They are both monetary and industrial, both liquid and constrained. This duality shapes their behavior under systemic pressure. Historically, silver does not respond immediately to early-stage dislocation. Its price can remain subdued even as monetary signals intensify. This delay reflects suppression through liquidity prioritization rather than absence of demand. As long as confidence in financial instruments persists, hard assets remain secondary. They are not required to perform their stabilizing function. The system prefers abstractions to physical anchors. However, when trust becomes conditional, the role of hard assets shifts. They transition from peripheral to referential. This transition is often abrupt because it reflects a binary reassessment. Suppression mechanisms can delay repricing, but they cannot eliminate it. When silver begins to move, it is usually not incremental. It reflects accumulated imbalance rather than new information. This dynamic is frequently misunderstood because observers expect linear behavior. Hard assets operate on thresholds, not trends. They remain inert until the system demands their function. The current environment exhibits characteristics consistent with early-stage delay. Interest exists, but it is muted. Positioning is cautious. This does not indicate irrelevance, but dormancy. Understanding this behavior requires patience. Silver is not a signal generator in isolation. It is a signal confirmer when trust dynamics shift decisively. Under prolonged systemic pressure, institutions prioritize continuity. Their primary objective becomes maintaining confidence rather than resolving imbalance. This is a rational response to uncertainty. Governments emphasize stability, central banks emphasize tools, and investors emphasize adaptability. Each actor manages its domain while avoiding acknowledgement of systemic limits. Narrative control becomes essential. Language is calibrated to reassure without committing. Risks are described as manageable, transitions as orderly, and challenges as temporary. This approach works until it doesn't. Confidence management relies on credibility, which erodes when actions diverge from assurances. Institutions then face a narrowing range of options. Psychologically, denial manifests as normalization. Abnormal conditions become framed as the new baseline. This framing reduces urgency but increases vulnerability. Investors adapt by focusing on relative performance rather than absolute security. This adaptation maintains engagement while masking systemic fragility. The danger lies in feedback loops. As confidence becomes performative, institutions rely on each other's reassurance. This mutual reinforcement delays adjustment while amplifying eventual impact. The system does not break because of bad intentions. It strains because of coordinated delay. If unresolved, quiet dislocation tends to produce structural reordering rather than collapse. Volatility increases, not as chaos, but as recalibration. Relationships that once held stable begin to fluctuate. Liquidity becomes episodic. Periods of calm alternate with sudden tightening. Markets adjust not to information, but to availability of trust. Institutions may consolidate power to manage instability. Regulatory frameworks evolve, often expanding oversight while reducing flexibility. These changes aim to stabilize but can entrench fragility. Capital flows adjust accordingly. Cross-border movements become more sensitive to policy credibility. Domestic systems face increased pressure to self-fund stability. None of this implies inevitability. Systems can adapt, but adaptation requires acknowledgement of limits, which is often delayed. The longer signals persist without integration, the more pronounced the eventual adjustment. This is not a forecast, but an observation grounded in system behavior. What matters most in this moment is not prediction, but awareness. The system is communicating through behavior rather than declaration. Listening requires patience and restraint. Quiet dislocation does not demand action. It demands attention. It asks observers to notice patterns rather than events, consistency rather than intensity. The global financial system is still functioning. That is precisely why these signals matter. They emerge when collapse is absent and confidence is assumed. Understanding them is not about fear or certainty. It is about recognizing when a structure is relying more on continuity than balance. History suggests that such moments are transitional. They are neither beginnings nor endings, but inflection points. Whether the system integrates these signals or defers them further remains unknown. What is clear is that something has shifted, quietly and persistently, and systems rarely shift without consequence.